Hello and welcome to this Mirror Facebook Live, all about government changes to national insurance this week, which affect almost all of us, and of course, what that means for your money. For those of you wondering why this session is happening on a Friday and not the usual Thursday, it's because the timing of it would have clashed with the Prime Minister's resignation speech yesterday. Apparently, he has no respect for plans the Mirror makes, so thank you very much for sticking with us. I'm Sam Barker, a money reporter at the Mirror, and I'm hugely grateful to be joined today by David Denton, technical consultant at financial firm Quilter and an expert in all things tax. Hello, David.
Hi, Sam. Good day to you.
Very good to have you on the call. So we're going to be talking about what's happened this week with national insurance and what that means for your take-home pay, state pension and more. And while there are some winners and losers with this one, for once there's actually a lot of good news. We're hopefully going to provide some useful information for everybody from national insurance newbies upwards. But we're also here to answer your questions. So if you have anything to ask or you just want to have your opinion heard, please feel free to post it in the chat and we will do our absolute best to answer both during the session and towards the end. So to set the scene, from this Wednesday, the government changed how much you can earn before paying national insurance. The idea behind this is to help Brits with the cost of living crisis by letting them keep more of their earnings. But that's not the case for everybody, as we're going to get into. But the changes do mean that some 2 million low-income workers will pay no national insurance at all, while millions more will see their tax bill reduced. So David, perhaps let's start by laying out what national insurance is, please, as there's a lot of myths surrounding what it is and how it works.
Yeah, absolutely. National insurance is just one of very many taxes. There are more than 100 taxes that we might pay in this country. Hopefully we don't pay all of them. It's been around since 1911 and it was first devised by Asquith. And the idea then was that a tax would raise a certain value for the government so that it could help those workers who at the time had lost their jobs or were too ill to work. And over a period of time, it's evolved quite significantly. And then probably next think about 1948 and Warren Bevan and the introduction of the health service. And national insurance is one of those taxes that contributes to the overall pot that allows some of these benefits to effectively be paid. But it's not as clear cut as it once was. So it is one of many taxes that aggregates to an amount of money that the Treasury has to spend and allocate on various different things. So it's not just that national insurance just pays for your pension or just pays for healthcare. The picture's a little bit more complicated than that these days.
Thank you, absolutely. I think it's worth hammering that point home because a lot of people think, oh, well, somewhere in the government, there's a little pot of money with my name on it. And, my national insurance contributions go into the specific pot and that's what pays my state pension. And obviously, as you say, it's a lot more complicated than that.
It is, and perhaps I can just break that down.
Yeah.
Can I break that down a little bit more, in fact? Because if I look back at the last tax year, the government raised through taxes and other means around about £900 billion. So that's 900 and then 9 noughts. It's an awful lot of money, but that's what it's got to spend. And they've got to allocate that spending appropriately. Now, just by way of indication, the total cost of the healthcare system last year was in the region of 200 billion. And the total cost of state pensions was about 100 billion. The amount of money that came in from national insurance was 160 billion. So as a matter of fact, the things that many people think that national insurance pays has to be topped up from other taxes.
With you, and we're going to get into other taxes as well. Whilst we're mostly talking about national insurance today, it is important to sort of understand where it fits within the wider system. But perhaps let's move on to sort of explaining what it is that's happened. What's the big news this week, and then we can kind of get into explaining how it affects people. So, David, can you run us through why is the government changing how national insurance works, please?
Yeah, so there've been 2 announcements in very recent history. One goes back to September last year that became effective from the start of this tax year, so just 3 months ago. And then a secondary announcement in the spring statement, which is effective from 6th of July, so the middle of this week. Now, the first announcement effectively caused people to pay more national insurance, and the second announcement allowed people to pay less national insurance. So let me break that down just a little bit. So from the start of this tax year, there's an incremental value as a percentage that people will pay through national insurance, and that applies whether you're employed for your earnings, whether you're an employer that also pays national insurance, or if you're self-employed on your profits as well. And that's largely increased the rates of national insurance you pay by 1.25%, pretty much across the board. So for the first 3 months of this tax year, people have been paying more tax through national insurance. Now, the design of that was very specific and purposeful, and that's because governments over recent years have been concerned about funding for the NHS, and they've called this health and social care. And we have now what's called a health and social care levy, and for the time being, that's going to be represented by this increment of 1.25% on top of the rates of national insurance you already pay, that you've already started to pay since the start of this tax year on the 6th of April. The interesting thing, though, was the second statement from Rishi Sunak in his spring statement this year, when he was very keen to help those people struggling with their finances with the huge cost of living increases. He was encouraged to remove that 1.25% increase, which is the health and social care levy. But what he said instead was, I'm going to increase the threshold for which people start to pay national insurance. And he's increased this in such a way that it's now in line entirely with the income tax threshold called the personal allowance. So if I can break that down, what it means is from the 6th of July, then the threshold on an annual basis above which you pay national insurance has gone up from £9,880 to £12,570. So now if you earn less than £12,570, you'll pay no national insurance at all. But for most people, of course, that extra legroom or headroom means that there'll be a slice of money or a slice of income you have that won't be subject to national insurance, albeit it's national insurance when you do pay it at the higher rate of 1.25%. And the knack here really is to understand what's the net effect of these two changes, the one that happened at the start of the tax year and the one that's happened this week. Now, just by way of government's publicity, it was very clear to say that 30 million people, on average, would benefit to the tune of £330, courtesy of the fact that the threshold at which you start paying national insurance has gone up. But I think in real terms, Sam, the interesting point for many people is what's the net effect of these two changes together? Am I a winner or am I a loser?
Absolutely, and we're going to be sort of getting into and kind of discussing that point as sort of in a couple of minutes on this call. I think it's probably worth pointing out. So a lot of people, will have written about a new calculator which the government has launched. The point of this calculator on paper is to help people understand how the national insurance changes will affect their take-home pay. But the issue with this calculator, kind of as David points out, is that it only takes one of the changes to national insurance into account. So the government's put up how much most people will pay national insurance by. They've then lowered the point at which you would sort of pay it. But what they've done is they've brought the calculator in between point A and point B, if you see what I mean. So we're not comparing, where you are currently with where you were this time last year. It's comparing where you are currently with national insurance already having gone up. So basically what that means is this calculator, if you go online and use it, as the government is kind of trying to get people to do, it's giving you a kind of inflated kind of good news figure. And now that said, there is an awful lot of good news here, and we're going to get into, as I say, this sort of the winners and losers. But just sort of stick with us a little bit, because we're just going to talk a little bit more about where national insurance kind of sits in the wider sort of tax system. So, David, perhaps could you mind sort of taking us through where does national insurance sit with relation to the other kind of taxes that we all pay, please?
Yeah, so as indicated earlier, there are over 100 variants of tax. Many of them are quite small and we don't think about them, things such as landfill tax and air passenger duty. And then there are the big ones that we pretty much all pay. So of the 900 billion that was collected last tax year by the government, we're looking at income tax at about 228 billion. Then we're looking at national insurance at 161 billion. And the other one we can't really avoid because we buy things, goods and services, is VAT at 143 billion. So actually national insurance at 161 billion is a huge amount of money that's collected. It's the second biggest tax that we effectively have in this country to raise revenue for the Treasury to spend, but it's nowhere near enough to pay for state pensions and the National Health Service put together. And it is for that reason the government determined they wanted this incremental tax, the health and social care levy, to be able to provide incremental benefits that the health service perhaps can't quite afford at this moment in time. Now, we'll get on to talk about this, I hope, but that will become a separate tax at a later date, which has an implication from what's in your pocket at the end of the day. But for this year, that extra tax is added to national insurance. And that's why we get, for most people, paying national insurance now, not at the rate of 12%, but 13.25%.
With you. And so we're going to, in a minute, we're going to get onto the biggie, the biggie with this, which is what does this mean for you, the winners and losers? Now, firstly, I just wanted to turn to a comment we've had from Lisa Fosbury. Thank you very much, Lisa. She says, everyone will suffer no matter what is done. The cost of living won't change. And if it does, it's going to take years for it to go down again. I think, very sadly, there's an awful lot of people who feel the same way. I think we're definitely looking at that being the case for this year. We certainly know that energy prices are almost certainly, unless the government steps in, they're going to go up to £2,800, maybe £3,000 a year for the average household from October. On top of that, obviously, the cost of living isn't just energy bills; it's grocery, the price of doing your shop in the supermarket, petrol prices particularly. But I think what we're hoping, and it's a little bit too early to tell, what we're hoping is that there will be sort of an increase through 2023, a decrease through 2023, and the picture might start to improve for a lot of households by that point. But just to say, this is an interactive call. If you've got any questions that you'd like answered that we kind of don't cover off through this call, please feel free to ask. David is not we're not really able to give kind of personal advice. What we can do is give kind of information which you might find quite useful. So with that said, thank you very much, Lisa. And David, let's talk about what with national insurance, who gains and who loses from what's happened this week. So my understanding is that there's a cut-off point, if you're up in terms of salary, up to that point, you're kind of gaining salary, take-home pay, and beyond that point, you're more likely to be paying more.
So what I'm going to do is give you three scenarios, and those three scenarios are people earning certain levels of income. And I want to really do this in terms of the net effect of what's happened over the past 3 months, because I think it'd be wrong to separate out what happened just 3 months ago and what's happening now. So 3 months ago, pretty much everyone was asked to pay more national insurance. Now, a lot of people are going to pay less. So there'll be winners and losers, but a lot more winners than losers, which I think is at least some encouragement. Now, I'm going to start off with a value that almost sounds like it's been plucked out of thin air, and that's just under £35,000. So if you're lucky enough to be earning just under £35,000, which is somewhere above the national average earnings, you'd be at the break-even point. So the net effect of the changes earlier this year and now would mean that your national insurance in total would broadly be about the same. I'm going to talk now about someone who earns about £20,000. And the reason I picked that number is because if you work 40 hours a week and you're above the age of 23 and you're on the minimum wage as such, you're probably earning just about or just under £20,000. And if we look at that person in particular and we look at the net effects of the changes, we can see that the rate or amount of national insurance that would have been taxable over the tax year last year, 2021-2022, that year that ended 5th of April 2022, the national insurance would have been £1,251. But this coming year, the one we've just started, but very importantly, because of the change on the 6th of July, effectively means the tax liability would be £984. So for that person on the minimum wage, 40 hours a week, the advantage, the extra money in the pocket spread over the year would be the equivalent of £266. Now, I am going to go to the other extreme to show how this works. And if you are well paid, very well paid, and you earn £50,000 a year, which means you're not quite a high rate taxpayer, but very nearly there, then you would be paying more national insurance. And you'd be paying £108 more national insurance than you were previously. So the break point, as I've said already, is just under £35,000. And the less you earn, the more the advantage in terms of the upside, because you're paying less national insurance than last year. Whereas the more you earn, even the greater amount that you'll pay this year, courtesy of those changes.
Perfect, great. And so basically, so just so we're all kind of on the same page. So everything up to £12,570 in earnings, you as of this week, you pay no national insurance on that whatsoever. If you take these two changes to national insurance together, if you earn up to £35,000 over the next year, what that means is you'll be better off. And then if you earn more than that, it means that you'll be paying more. I think the elephant obviously in the room with this is soaring inflation and the higher prices that people are paying. But I mean, it's certainly on the face of it good news, and more pounds back in pockets who are kind of working up to that £35,000 point. Now, there's also a state pension point here. So, David, do you mind talking us through, what do these changes to national insurance together, what do they mean for state pensioners, please?
Yeah, I mean, the state pension is something that we all look forward to at what we call state pension age. And for most people retiring now, it'd be 66, but it is planned to increase. And at that point, you draw value from the state, as most people recognise, and it provides them a guaranteed income for life. Now, what you benefit from in terms of that state pension, which is now called the new state pension, and this can get confusing because the state pension changed a little bit in 2016. So broadly, that's the old state pension, and now we're in the new state pension, if I can call it that. And the amount that you get largely revolves around how many qualifying years of national insurance contributions you've made. So it's actually really important as you're thinking about your retirement to work out and go for a forecast, which you can do online or by telephone, to work out what is available to you at that point in time that you retire, normally at 66. Now, the more qualifying years you have, the greater the pension you're going to have. And these are qualifying national insurance contribution years. And I guess what's really important here is how many years do you need to contribute to national insurance to get the maximum out of it? And how many years do you have to contribute to get something out of it in the first place? Now, what I say might seem out of kilter with what you might expect, and that's because of the changes in 2016. So I'll spell this out very briefly. Until 2016, even 1 year's qualifying contribution worth of national insurance, you would have had some form of state pension when you retired. And 30 qualifying years would have got you at 66 the full state pension. Now, post-2016, we need a minimum of 10 years to get any benefit and 35 years to get the full benefit. So what's really relevant there is, if for some reason you don't have 10 years, but you're close to it, and you could afford to make a voluntary contribution, which is called a Class 3 national insurance contribution, a small contribution to secure an extra year or more's credit could give you a really valuable income for life. It's generally considered the cost of making that incremental contribution to buy an extra year of qualifying contributions is incredibly valuable for the person who will live the average age having retired at 66. So today what we're looking at is a minimum of 10 years to get anything and 35 years to get the maximum pension. And I think, Sam, it's also fair to say now that the actual full new state pension is potentially a little bit more generous than some people would imagine as well.
Absolutely. So, I mean, we're certainly going to come on to that because there's really good news as it stands for state pensioners next year. But I think it's, basically it's sort of worth making the point that if you are perhaps, you're earning currently, you're working currently, and you earn somewhere under £12,750, but previously you were earning maybe more than 9,880. If you fall within that gap, there is a risk that you will not be earning enough to pay national insurance and therefore get the kind of level of state pension that you might like. As David says, there is a way of kind of getting around this without turning to your boss and saying, "Hello, can I have a big pay rise, please?" You can actually later in life basically top up your national insurance credits by making a sort of one-off payment or series of payments if you want, and that will kind of boost your state pension up to the sort of level that you might like. Now, just while we're on the subject of state pension, David, you just sort of mentioned that there could be some really good news for state pensioners next year.
Yeah, I'd like to just explain how the state pension goes up each year, because it does in April each year with the tax year. And for a number of years now, we had something called the triple lock, which sounds quite complicated, and it means that the pension should go up every year by the higher of one of three measures. And one measure is a fixed measure of 2.5%, the other is earnings growth, and the other is inflation, as represented by RPI, CPI. Now, the fact here is that last year, the link there to the triple lock was broken, and that's because earnings last year, surprisingly across the board, growth was quite high. So from the start of April this year, there was an increase of just above 3% for all pensioners. But this year, Rishi Sunak has effectively promised that the link won't be broken for the coming year. And the coming year, it does look like that inflation will be high, as we all know, which is causing this difficulty in the cost of living. And that inflation rate that will get factored in, which is declared in September of this year, will be the inflation rate that's then used to increase the state pension. Now, if I look at the last declared value, which is put out by the government on a monthly basis, we're looking at the value of 7.9%. Now, the predictions from a number of people, both externally and in government, are indicating that in September, although it's pretty difficult to rationalise, inflation could be at the rate of in excess of 9%. Now, clearly that's not good for us today because the cost of living is going up, but that 9% now intended to be used to increase the value of that state pension with increases next year. I'll just give you an indication, if you're on the full state pension at the moment, that income is £9,628 a year. But if it increased in the region by around about 9%,
Oh, sorry, we might have a bit of technical difficulty there. I think David's monitor might have frozen. We've had a question where hopefully you'll be able to sort of dial back in, and we'll be able to hear the rest of that point. In the meantime, I've got a comment here from Hazel Greenstyles. Hazel says, when is the old state pension going to be increased? It is a disgusting amount of money, which required 30 years contributions. If one can't get pension credit, it's not livable. Hazel, I'm really sorry to hear your situation. I think there's an awful lot of people certainly that write to us and they express kind of similar views. Unfortunately, as it stands, there are no planned increases to the old state pension beyond the kind of triple lock increases every year, and it is lower than the new state pension. But on your point about pension credit, hello again, David. We're just going to come back to your point there. I was just answering a quick question from Hazel. Yeah, Hazel, coming back to your point about pension credit, I think it's really important to hammer home this point. For anybody on the call, is that pension credit is a severely underclaimed benefit. There are huge numbers of people in this country who are eligible to claim pension credit, but you have to do it yourself. The government won't give it out for you. The government knows that not enough people are claiming it, and it's really about just driving that message home. This benefit is out there, it's waiting to be claimed. The government has set aside money for it. We've certainly written guides on the Mirror website which are free to read, about how you can claim this money. And thank you so much for commenting. So David, just sort of turning back to you, we were sort of talking a little bit about why good news for state pensioners next year and kind of an increase, hopefully a big increase in the level of state pension from April.
Yeah, that's right. On the basis that, as we all know, inflation is rather high and makes things incredibly uncomfortable for very many of us. The same value of inflation as recognised by the government in September this year will be used to increase the state pension from April next year. Now, the predictions are that it could actually peak around about then. Now, we don't know if that will be the case or not, but the suggestion is it could reach between 9 and 10%. Now, that 9 and 10%, of course, in terms of inflation that affects our cost of living, will come down at some point, and government's predictions are quite quickly after that. But if we get that value at 9 to 10% in September, that is a value that will be used to increase the state pension from April next year. And once it's applied, of course, it's locked in. So for those people who are enjoying a state pension potentially, and those who are going to soon claim it, there is some backhanded benefit, if I can call it that, by that inflation rate being high. And of course, Rishi Sunak has made the decision that he will honour that triple lock even though he recognises the rate of inflation will be high and will therefore be costly for the Treasury. Of course, it will be good for pensioners.
Exactly. So whilst, if you were a pensioner, you're going to be paying more in the cost of living this year, particularly with energy bills because of high inflation. There is a kind of delayed, hopefully benefit to that, which is that if inflation remains high in September, your state pension will go up by that amount. And whilst no one's got a crystal ball, the Bank of England certainly seem to think that inflation could be 10 or 11%. Later this year. So, with any luck, we could be looking at a state pension increase of that figure next year. Now, let's just recap. So, we've everything to do with national insurance. So, if you earn up to around £35,000 a year, the big message here is that you will get to keep more of your money after tax. If you earn more than that, you will pay more. When it comes to the state pension, watch out if you earn more than around £9,880 a year, but less than 12,750, because it may be that you fall out of paying national insurance, which you might think is brilliant, but obviously, long term means that the level of your state pension might drop as well. So that's everything that we sort of discussed in a nutshell up to this point. Now let's take a little bit of a look at the future. We've been speaking about national insurance changes this year, these two very big national insurance changes. But if we turn the clocks forward to next year, there's going to be yet another one. And we sort of hinted at this on the call so far, but we're going to kind of get into it in a bit more detail now. So David, would you mind talking us through next year, how is, if we talk about national insurance and this social care levy together, how are things going to change for taxpayers?
Yeah, so when the government announced they wanted to raise more money to help the healthcare for the nation, they wanted to have a specific levy, the Health and Social Care Levy. But they wanted to start collecting that money soon, but they didn't have a system to do it. So they therefore decided to increase national insurance as a substitute. Now, the intention is that from the start of the next tax year, in other words, 6th of April 2023, though we'll still have to pay that extra amount, it'll be by way of a separate tax. So the national insurance increase of 1.25% for those people who are above the thresholds and pay national insurance, that 1.25% increase should be taken off national insurance, so it'll go back to its original level. And then a separate tax will apply to raise the same value for the Treasury. Now, unfortunately, there is a bit of a disappointing aspect to that potentially for some people. And that is that not everyone reaching 66 and claiming state pension will retire. Many people are working because they're able to beyond that date, and there is an implication. And that's because national insurance contributions are generally payable between the ages of 16 and 66. So this enhanced level of national insurance, increased by 1.25% that we see this year, well, that would only apply until you're age 66 for most people. But when the extra taxation, the Health and Social Care Levy, is separated out, that's going to be a tax that is likely to apply on earnings throughout life. So though it will be good news, apparently for some, that the 1.25% comes back off, it's only just been added this year. If you are working, then there is the possibility, of course, that that earning will be subject to that 1.25%, but by a separate tax altogether. So this is rather complicated in its own right.
Exactly, and as this comes, as this sort of rumbles closer, as we get towards April, we'll be making sure that we kind of bang the drum and kind of explain this. But yeah, I mean, certainly as it stands, the government at the moment are very keen on kind of making quite a lot of big kind of changes to the way sort of tax and money works. But yeah, it does look like there could be an additional tax to pay at a sort of a later point in people's lives than perhaps they've been used to. But I suppose, the kind of good news is that this money, in theory, should be used to pay for things that are very dear to people, funding the NHS and social care, which has been, I think, kind of ignored and kind of kicked down the road a bit as an issue by kind of successive governments, unfortunately. Now, I just wanted to say, thank you to everybody who's tuned in on this call. I hope you found it helpful. I mean, sadly, I think this is just about everything that we've had time for today. We'll be back every Thursday at 1 p.m. With future Facebook Lives. And I wanted to say thank you as well very much to David for all of your kind of technical expertise today. It's been really invaluable. Thank you so much to everybody, and we'll see you all next Thursday at 1 p.m.